You know, and I think you asked that question very well on Twitter today. Serious question. How long does this last before we start to take it seriously? And it's obviously the 2s and the 10s we're taking seriously now, not the 3-month and the 10-year or the 3-month.
Which has been inverted for 3 months.
Exactly. 3 months is exactly what people that have been watching this for a long time will tell you. If the 2s and the 10s were inverted for 3 months, it's certainly going to tell us things are slowing down. But not just because it's lasted that long, because it causes that slowdown. If the banks can't, borrow short and lend long, business slows down. So there's a causal relationship to the inverted yield curve over a period of time that will slow down economic activity. But I think what we have to look at is, when was the last time we've had an inverted yield curve where the integer was less than 5?
And 5 basis points?
5%. 5%. So the 2s and the 10s have always inverted when we've been 5.4 versus 5.2.
Oh, I see.
Right? We have a single-digit integer that's causing this inversion. We haven't had that before. We certainly haven't had.
What does that mean?
We don't know. We don't know what it means when there's $17 trillion of negative yielding debt. We haven't had an inverted yield curve when that was the case. So we're trying to apply all the metrics that we've used for past inverted yield curves to today, which is a starkly different environment. So I'm not saying that it's not a warning sign. I'm just telling you it's a warning sign in an environment that's completely different from any other inverted yield curve we've had.
Joe, how do you factor in this potential recessionary signal, particularly when you see things like consumer confidence, which is still extremely high out there?
Well, look, at first and foremost, we're in a global world, and our rates are still relatively attractive compared to everyone else. They're still positive. And I do agree with Art that makes some noise. I do feel concerned because there are some things that are speaking about a slowing economy, most especially what's happening with small caps. It's hard to explain why in an environment where interest rates are going down, which mostly benefits small companies, they're doing so poorly. They're not exposed to the trade battle as much, and yet they're 15% off their tops.
Do you think they're sniffing out a recession?
That is my concern. I'm seeing that. I'm seeing the global markets clearly. They recovered after us, and they never really got to the heat we did, and they're leading the way down. And so right now, the S&P 500, and most importantly, the growth companies in the S&P 500 are holding up the entire market. That's not a great sign. Now, again, typically when you get an inversion, it's still a year later that the market still is hitting new highs and only starts going down about a year after the inversion. Mm-hmm. So again, that doesn't mean that the markets are going to go down. I'm not necessarily sure it means that we are in a recession.
Joe,
I just don't like seeing the small caps doing so poorly. It's a bad sign.
It's a great point. It's been happening for years now, sort of that chronic underperformance. I'm just curious, at a time when people would say, okay, well, this recession indicator, let's call it, makes me want to get defensive, but all the defensive parts of the market are the most expensive and crowded. What should people do?
Well, interestingly enough, the dividend payers are at a bigger discount in valuations to the non-dividend payers than they have been in 40 years. So some research from the folks at Goldman that actually did the analysis. So a lot of the dividend payers are actually valuation-wise, as counterintuitive as it would sound, with low interest rates, you would think everyone would be crowding the dividend companies, but they're not. So it's a very interesting scenario where people are actually defending themselves by owning Apple and a lot of the names that you would not expect to be doing that well because there's a rush for anything that's growing. And so, again, people have not yet moved from the yield curve and saying, I'm going to start getting paid by my equities because they're concerned about the stock market. So, again, what I would suggest is make sure that your overall allocation is in line, that you can put up with some volatility, because it's hard to imagine. We've had a 15% run on the S&P still, even with this so far this year. So it's been a good market. Just make sure that you're prepared for what could be a very messy next few months.